Morning. Welcome to Ainslie News. Today, Wednesday, 3rd of June, 2020. Today we're talking the AUD. Can it last up this high? The Aussie dollar this morning nudged 69 cents for the first time since January this year, and where it plunged to a 57-cent handle in March. At that time, everything and everyone piled into the US dollar, and Australia was thought to fare comparatively badly from the virus, given our AUD is a proxy for commodities and China. That, of course, made gold and silver in AUD terms surge even harder than the USD spot price. Just check out this graph here. Aussie dollar versus US dollar. That rebound in the Aussie dollar has taken the shine off the performance for gold, for Aussies, bringing it almost back in line with the USD spot price performance for the year, up 14%, with the AUD gold up 16%. At one stage, we were in the mid-20 percentages. Notably, however, gold is still the best performing asset this year, as shown in the next graph. Total return performance of major global financial assets year to date. Not bad for gold. And as always, late to the party, silver was the third best performer globally in May. Shown in the next chart. Total return performance of major global financial assets in May. Few would have thought we'd see a 69-cent AUD. The reasons, however, include a softening US dollar at present, a surging iron ore price due to the virus supply constraints, particularly from Brazil, and hopes that new stimulus being unleashed in China will see good old China to the rescue again for our resources sector. There is also seemingly a sense that our virus response and isolated island home has seen us fare better than elsewhere. However, that ignores the fact that we're largely a supplier to the world that is not doing so well. We are largely a two-trick pony of resources and building homes. And what if the world doesn't need our resources and Brazil comes back online and immigration stalls to protect the aforementioned island? Yesterday saw the RBA hold our interest rates at 0.25%, and Governor Philip Lau has again stated that taking rates into negative territory is extraordinarily unlikely. That, of course, is bullish for the AUD in a world awash with zero and negative rates by comparison. Adding fuel to this is the announcement yesterday that China will start their own version of QE, which will see the PBOC buying 40% of uncollateralized loans to small and medium-sized firms from qualified local banks. The stated objective is to free up local banks' balance sheets to allow them to, you guessed it, lend out even more to their businesses. This from a country with a world-leading debt to GDP of 317%, according to the Institute of International Finance, compared to the GC lending 250% of Japan, and most of that into such businesses. Here's a chart showing the sharp surge in debt in China. That's raising up pretty quickly. Two prominent economists yesterday voiced opinions that, regardless of RBA posturing, Australia could see negative rates within 12 months. Royal Bank of Canada Capital Chief Economist Su Lin Ong and Westpac economist Bill Evans both sounded the same warning. And this from the AFR. A serious case may be made for the RBA to consider further cuts and entering negative territory for the cash rate if it becomes apparent that the economy is deteriorating even more than it is currently expected. Although there is a clear message from the RBA that policy is on hold, circumstances can change, and astute policymakers, as the RBA has proven to be over many decades, can be expected to adjust accordingly. Mr. Evans suggested a more competitive exchange rate stands out as the key benefit from the central bank moving to negative rates. As investors get lower returns on the money they lend in Australia, they are less likely to demand Australian dollars, which depreciates the currency. For small open economies like Australia and New Zealand, improving the competitiveness of the exchange rate has more direct implication for jobs and inflation than a large, relatively closed economy like the US or even Europe. That last paragraph is key. A measure of a currency is only ever relative to another or a basket of others. Australia's economy needs, and is only going to get more and more, a globally competitive AUD. The RBA know this and will throw the kitchen sink at making sure it doesn't get too strong. Technically, the AUD is now at a key resistance, and pressure is on the downside. From a macro perspective, Real Vision subscribers know that Raoul Pal is short the AUD, and he sees both a stronger USD and expects a crash in commodities as part of the deflation crisis, and sees the AUD as a commodities currency proxy. Today, we get the first quarter of 2020 GDP print for Australia, which of course includes the lockdown month of March. Westpac are experiencing negative 0.4% and CBA negative 0.3%. A much worse negative print for Q2 is baked in the cake, and that means a technical recession, our first in 30 years. Today also sees the release of April dwellings approvals numbers, and Westpac are predicting a 15% plunge. In line with the already released AIG PCI construction index falling 16.3 points in April, led by apartments and commercial building. No surprises then, the government is looking to unleash more stimulus into the Aussie home Ponzi scheme. This multi-decade fixation of artificially stimulating one of the world's most inflated property markets because it is one of the pony's only two tricks can only eventually end badly. We already have the world's second highest private debt burden, and they want it higher. Our public debt by comparison on the world stage is low, though that is quickly changing. Arguably the nation's best independent property mind is National Property Research Matthew Gross, who recently broke ranks from an industry begging for more by suggesting, God forbid, that Australia use this opportunity to grow new businesses. And if we really need to prop up an industry that does admittedly employ 1 in 10 Australians, then make that investment in Australian housing more egalitarian. It's definitely worth looking more into. Regardless of where it's spent, a central theme for Australia, as with the rest of the world, is monetary stimulus, either via such government fiscal packages or central banks, rates, policy, and QE. A strong AUD seems short-lived. Billionaire Wall Street legend Paul Singer, founder and president of Elliott Management Corp., describes gold's role and prospects in this environment succinctly via his just-released Perspectives investment letter. This is a perfect environment for gold to take center stage. Fanatical debasement of money by all of the world's central banks, super low interest rates, and gold mine operation and extraction issues, to a large extent related to the pandemic, should create a fertile ground for this most basic of all money and stores of value to reach its fair value, which we believe is literally multiples of its current price. In recent months, gold has gone up in price to some degree, but we think that is one of the most undervalued investable assets existing today. It is the answer to the question, is there an asset or asset class which is undervalued, underowned, which would preserve its value in a severe inflation, and is not adversely affected by COVID-19 or the destruction of business value that is being caused by the virus? And that's news today. Thanks for tuning in. Remember, you can always go over to ainslieBullion.com.au to read any of our articles. We'll catch you tomorrow.